Imagine this. Just 48 hours ago, the world watched in awe as Bitcoin shattered its own previous records, catapulting to an astonishing 123,000 United States dollars per coin. The screens of crypto exchanges flickered with green candles. Crypto enthusiasts, both seasoned veterans and newcomers alike, filled social media with euphoric posts and memes celebrating the unstoppable bull run. The general sentiment was electric. Many believed that the journey upward was just beginning, and dreams of a new all-time high seemed within reach for millions around the globe. But then, almost as if someone had flipped a switch, the exuberant party came to an abrupt halt. Bitcoin, the original and still dominant cryptocurrency, tumbled below 117,000 United States dollars in a matter of hours. In those frantic moments, billions of dollars in value vanished from the digital asset markets. Panic replaced euphoria. Commentators and traders scrambled for answers. What triggered such a sudden and dramatic reversal? And perhaps even more importantly, could this happen again? And what does it signal for the future of digital money? To fully understand this roller coaster, let's rewind and trace the journey of cryptocurrency itself. A journey that began less than 2 decades ago. The story of Bitcoin and its digital descendants starts in the shadow of the 2008 global financial crisis. As banks collapsed and governments bailed out, institutions deemed too big to fail, trust in the established financial system was shaken to its core. In this climate of uncertainty and skepticism, an enigmatic figure, or perhaps group, going by the pseudonym Satoshi Nakamoto, published the white paper for Bitcoin. The vision was radical: a form of money that was decentralized, borderless, and resistant to censorship or manipulation from authorities. No central bank, no single point of control, just mathematics and code. For years, Bitcoin remained the domain of cryptography enthusiasts, libertarians, and technologists. Mainstream finance dismissed it as a passing curiosity or a tool for illicit transactions. But by 2017, the landscape had changed dramatically. Ethereum emerged, introducing smart contracts, self-executing agreements coded right onto the blockchain. This innovation gave rise to decentralized applications, or DApps, and launched the now infamous initial coin offering boom. Suddenly, anyone with an idea and some coding experience could raise millions of dollars in seconds by issuing their own tokens. Of course, this golden era was not without its pitfalls. Many projects overpromised and underdelivered. Scams proliferated, and regulatory agencies began to take notice. When the bubble inevitably burst, investors who had poured their savings into speculative coins and tokens saw their portfolios shrink to a fraction of their former value. The crash after the ICO mania was severe, teaching hard lessons about hype cycles, due diligence, and the dangers of untested technology. Yet, cryptocurrency would not be relegated to the history books. By 2020, a phenomenon known as DeFi summer swept through the industry. Decentralized finance platforms allowed users to lend, borrow, earn interest, and trade, all without traditional banks or brokers. This sparked a new wave of innovation, but also brought fresh risks. Smart contract vulnerabilities, rug pulls, and exploitative attacks that resulted in millions of dollars lost. The community was forced to grow up quickly, prioritizing security audits, transparency, and robust governance. Now, as we find ourselves in the middle of 2025, the landscape has evolved beyond recognition. Cryptocurrencies are no longer the exclusive playground of tech enthusiasts or fringe ideologues. Wall Street giants, multinational corporations, pension funds, and even small-town investors are participating. The market has matured, but it has also become more complex and, in many ways, more unpredictable. This mainstream adoption has brought with it a new set of challenges. Regulatory bodies from the United States Securities and Exchange Commission to the European Union's financial authorities have stepped up scrutiny. New financial products, like crypto-based exchange-traded funds, ETFs, have been launched, offering easier access but also introducing new risks. And most importantly, the sheer volume of institutional money means that price swings can be larger and faster than ever before. As Michael Saylor, the CEO of MicroStrategy and one of Bitcoin's most vocal advocates, succinctly put it, Bitcoin remains the best performing asset, but make no mistake, this market is not for the faint of heart. So what exactly caused the sudden and violent market crash this July? The answer is a fascinating blend of human psychology, market mechanics, technical factors, and the colossal influence of so-called whales, the largest holders in the crypto ecosystem. Let's start with human behavior. When Bitcoin touched its all-time high of $123,000, a wave of profit-taking swept the market. Long-term holders, investors who had accumulated Bitcoin over at least 155 days, chose this moment to cash in. According to data from Glassnode, these seasoned investors realized nearly $2 billion in profits in just a single 24-hour period. That staggering sum represents one of the largest profit realization events in crypto's history. It's a classic case of buy low, sell high. And after such a meteoric rise, who could blame them for taking some chips off the table? But this only scratches the surface. The actions of whales entities or individuals who hold enormous amounts of Bitcoin had an outsized impact. On the Binance exchange alone, whales transferred approximately 1,800 Bitcoins in one day. Transactions valued at over $1 million made up more than one-third of all Bitcoin inflows to the exchange during this window. For the average trader, this is akin to swimming in a pool where a handful of people can create tidal waves with a single move. When these giants act, the market feels it instantly. Paul Howard, an analyst from Winsent, explains, after a huge price spike, mean reversion is almost guaranteed. In other words, when prices move sharply in one direction, the market tends to pull back toward its average. This time, the pullback was particularly harsh. Ethereum, the world's second-largest cryptocurrency by market capitalization, slipped below the psychologically significant level of $3,000. XRP, which had been rallying to $3, was met with strong resistance and lost significant ground. Dogecoin, the infamous meme coin that once started as a joke, plunged by 8% in a matter of hours. In fact, Dogecoin led the losses among major cryptocurrencies, a testament to just how volatile the market can be. Altcoins, cryptocurrencies other than Bitcoin, often experience even wilder swings. The technical factors exacerbated the sell-off. As Bitcoin's price surged from $108,000 to $123,000 in less than a week, it created a supply gap between $110,000 and $116,000. This means there were very few established support levels in this range, making the market vulnerable to sharp, sudden price movements. When the selling began, there was little to cushion the fall. Meanwhile, institutional traders were busy rebalancing their portfolios in anticipation of upcoming crypto ETF launches. Regulatory pressures were mounting as well. In the United States and across Europe, new rules and guidelines were being drafted and debated, with many set to take effect before the end of the year. For ordinary investors, these developments sowed uncertainty. Are these sharp corrections a sign of the market maturing, or are they the beginning of a much deeper downturn? The answer, as is often the case in markets, depends on whom you ask. Some experts, like Katie Stockton at Fairlead Strategies, see the recent turbulence as a healthy and necessary consolidation before the next upward surge. Short-term consolidation is common after such a rally, she notes, suggesting that the market is simply catching its breath before the next move. Others, like Willy Woo, well known for his in-depth analysis of blockchain data, point to on-chain metrics showing strong accumulation by long-term holders. More than half of the recent profit-taking came from these veteran investors. But at the same time, new buyers are stepping in, and the total number of wallets holding significant Bitcoin balances continues to rise. This, Wu argues, could mark the beginning of a new accumulation phase, the calm before the next storm. But not everyone is so optimistic. Raoul Pal, founder of Real Vision and a respected macroeconomic thinker, stresses that forces beyond the crypto industry are at play. Interest rates, inflation fears, and global economic pressures all have the power to sway digital asset prices. Regulatory developments, in particular, can send shockwaves through the markets overnight. Consider the ongoing XRP saga. As the United States Securities and Exchange Commission's stance remains unresolved, institutional traders have become increasingly cautious, de-risking their portfolios ahead of events like the much-anticipated ProShares XRP Futures ETF launch. And then there's the specter of regulatory change in Europe. The markets in crypto assets, MiCA regulation, expected to be fully implemented by the fourth quarter of 2025, promises to bring clarity, but also new challenges. If MiCA delivers on its promise of clear rules for institutional and retail investors, it could unlock a fresh wave of participation from major financial players. But if the rules are too restrictive, there's a real risk that innovation could be stifled, driving activity underground and increasing volatility. Meanwhile, technical indicators across the market tell their own story. The rapid retreat in Bitcoin's price from its record high was accompanied by a surge in trading volume, especially in large, institutional-sized transactions. Data from CryptoQuant shows that whale deposits on Binance spiked dramatically, signaling that some of the largest players were either locking in gains or hedging positions as volatility peaked. These large-scale moves often precede significant price shifts, and this time was no exception. Let's take a closer look at some of the other major cryptocurrencies. Ethereum, after testing levels not seen since February and briefly approaching $3,100, failed to hold its gains. The rapid reversal erased much of the progress made during the previous sessions, and profit-taking was evident across the board. The annual percentage rate for staking Ethereum, a key measure of network health and investor confidence, fell from 4.2% to 3.8%. Indicating a slight decrease in staking rewards and possibly contributing to the selling pressure. XRP, long a favorite among traders for its high-profile legal battles and institutional partnerships, faced stiff resistance at the $3 mark. Despite an initial surge, systematic profit-taking and corporate rebalancing, especially ahead of the ProShares XRP Futures ETF launch, drove the price down by 8%, from $3.02 to $2.78. The price is now consolidating between the $3 level and a support zone defined by the highs seen in May, around $2.59 to $2.65. Then there's Dogecoin. Often dismissed as a joke, Dogecoin proved its volatility once again by plunging 8% in a single session. Two key trading windows saw volume spikes of over 700 million coins, dwarfing the typical 24-hour average. The price action suggests that both retail traders and institutional players were active, with the sell-off coinciding with delays in crypto ETF approvals and a renewed debate over the regulation of centralized exchanges in the United States. Interestingly, Dogecoin's network hash rate, an indicator of mining activity and network security, increased by 15%, suggesting that some participants remain confident in its long-term prospects, even as the price fluctuates wildly. Other critical data points from the past week highlight the market's complexity. Tether, the world's largest stablecoin, saw its market capitalization reach $120 billion, underscoring the continued demand for stable, dollar-pegged digital assets as traders seek safe havens during turbulent periods. Meanwhile, Coinbase, one of the leading cryptocurrency exchanges for institutional investors, reported a 10% decrease in trading volume from its largest clients, a signal that some big players are sitting on the sidelines, waiting for greater clarity before making new moves. And amid all this chaos, MicroStrategy, the business intelligence firm led by Michael Saylor, now holds a staggering 250,000 bitcoins, cementing its status as one of the largest corporate holders of digital assets worldwide. In a similar vein, the Bitcoin Lightning Network, a technological upgrade designed to make Bitcoin transactions faster and cheaper, quietly surpassed 6,000 bitcoins in capacity this July. This is a clear sign that, beneath the surface-level volatility, innovation and adoption are continuing to accelerate. What does all this mean for you, the viewer? Above all, it's a powerful reminder that volatility is not a bug in the crypto markets. It's a feature. Emerging markets are always characterized by sharp moves up and down. Yes, wild price surges are often followed by equally dramatic corrections. For those new to digital assets, this is the #1 lesson. Never invest money you can't afford to lose. And always be ready for rapid changes in market direction. For more experienced investors, these cycles present both risks and opportunities. Profit-taking is normal after all-time highs, but rapid sell-offs can expose structural weaknesses in the market, especially when there's little technical support. The recent drop, from $123,000 to $117,000, was exacerbated by a supply gap and thin liquidity in the critical range between $110,000 and $116,000. In such conditions, even a small wave of selling can trigger outsized price swings. Expert Linda Shi from Scalar Capital offers this perspective. Long-term success in crypto depends on understanding both the technology and the regulations. In other words, it's not enough to read price charts or follow social media sentiment. Savvy investors keep an eye on policy changes, like the forthcoming MiCA framework in Europe, or possible new moves by the United States Securities and Exchange Commission. These regulatory shifts can create both headwinds and tailwinds for digital assets, shaping the next phase of growth or contraction. So what's the practical takeaway? Build your crypto strategy around discipline and flexibility. Instead of trying to time every top or bottom, a notoriously difficult task even for professionals, consider dollar-cost averaging. This means investing a fixed amount at regular intervals, regardless of the price, which can help smooth out the effects of volatility. Diversify across different assets: Bitcoin, Ethereum, stablecoins, and, if you're adventurous, a carefully chosen mix of altcoins. Remember that large, sudden moves, both upward and downward, are often driven by institutional flows and whale activity, not by retail hype alone. Let's also consider the broader implications for the future of cryptocurrency. On one hand, Bitcoin could solidify its role as a mainstream store of value, rivaling gold as a hedge against inflation and global economic instability. This would require ongoing institutional adoption, regulatory acceptance, and growing awareness among retail investors. On the other hand, the rise of decentralized finance, DeFi, could transform traditional banking by offering decentralized lending, borrowing, and trading platforms, assuming developers can overcome challenges related to scalability, security, and regulatory compliance. There's also a more pessimistic scenario. If governments around the world impose overly stringent rules on exchanges, wallets, and DeFi protocols, innovation could be stifled, pushing much of the crypto activity underground. This would make it harder for both individuals and institutions to participate safely and transparently, potentially increasing volatility and risk. What about the experts? Katie Stockton continues to anticipate a short-term consolidation before a potential breakout, while Willy Woo points to on-chain metrics that suggest a healthy phase of accumulation. Raoul Pal warns that macroeconomic forces, interest rates, inflation, geopolitical instability will continue to dominate market sentiment. Changpeng Zhao, CEO of Binance, believes that increased regulatory scrutiny will ultimately lead to greater market maturity, filtering out bad actors and paving the way for sustainable growth. Meanwhile, Michael Saylor maintains that Bitcoin remains the best-performing asset of the decade, despite the inevitable volatility. Let's not overlook the technical progress happening behind the scenes. The Bitcoin Lightning Network, for example, has reached a new record with over 6,000 Bitcoins in capacity. This technology allows for near-instant, low-fee transactions and could play a crucial role in scaling the Bitcoin network to support everyday payments. Meanwhile, developers are working tirelessly to improve the security and usability of decentralized applications, making it easier for ordinary people to participate in the new digital economy. For those who are still skeptical, consider this. The world's largest stablecoin, Tether, now boasts a market capitalization of $120 billion, reflecting the massive appetite for blockchain-based financial tools. And while Coinbase's institutional trading volume has dipped by 10%, many analysts interpret this as a sign of temporary caution rather than a fundamental loss of interest. As soon as regulatory clarity emerges, a new wave of institutional capital could flood into the market, driving the next leg of growth. So is this latest crash a healthy pause in a long-term bull market, or the beginning of a deeper downturn? Based on the data and expert analysis, it appears more likely to be a consolidation phase, a period of digestion and rebalancing before the next big move. On-chain accumulation, increasing Lightning Network capacity, and the steady implementation of regulations like MiCA all point to a maturing market. But as with any frontier, uncertainty remains high, and the only certainty is change itself. Here's a secret often overlooked in the headlines. Despite the stormy price action, innovation is still accelerating beneath the surface. The Bitcoin Lightning Network quietly achieved a record capacity in July, signaling growing adoption and technological progress. Developers are pushing forward with new solutions for privacy, scalability, and interoperability, laying the groundwork for the next wave of breakthroughs. If you found this breakdown helpful, don't forget to smash that like button, subscribe for more deep dives into global economics and technology, and hit the bell so you never miss a trend. What do you think? Are we heading for new all-time highs soon, or is the worst yet to come? Share your thoughts, predictions, and questions in the comments below. Your perspective is what makes this community great. Thanks for watching, and stay tuned for more insights as we continue to